We all know what's really been driving gold over the last 3 years. It's been central bank buying. I think there's just a lot of demand on the sidelines. And of course, the central banks are continuing to buy. The Chinese in Hong Kong have that history where gold, when they bought gold over after Mao took over, it saved them. The Vietnamese have a history of gold. Germany, Italy, these countries is still in the DNA that gold is a safe haven asset.
Gold continues to prove itself as one of the world's most reliable stores of value, and the latest numbers show just how aggressively central banks are still buying it. Their demand helped push gold to new record highs in 2025. In the third quarter alone, central banks bought about 220 tons, which is 28% more than Q2 and above the 5-year average. Even though gold prices have surged nearly 50% since the start of the year, that hasn't stopped central banks from adding more to their reserves. So far in 2025, they've purchased 634 tons, a bit less than the past 3 years, but still far above the pre-2022 norm of 400 to 500 tons. The World Gold Council's Q3 2025 report also shows total global demand hitting 1,313 tons, worth roughly $146 billion, the highest quarterly demand ever recorded. According to Adrian Day, president of Adrian Day Asset Management, this strong demand is likely to continue. He notes that the only short-term risk for gold is the upcoming Federal Reserve decision, since markets have already priced in a rate cut. But overall, the latest data backs his view. Gold's rise isn't hype or a bubble, it's a long-term shift fueled by central banks, wealthy investors, and growing global uncertainty. Let's dive into today's video to uncover some valuable insights. Don't forget to subscribe and hit the notification bell so you never miss an update.
We all know what's really been driving gold over the last 3 years. It's been central bank buying. At the beginning of the year, we saw, on top of that, we saw Chinese non-official buying, and that sort of went to a huge spike. That accelerated throughout the year and went to a spike in October. And of course, we've had increased buying from wealthy families, wealthy institutions, whether in Asia, Middle East, particularly those two, but also in Europe, and to some extent in the US, just as a defensive insurance measure in the face of unrelenting and growing fiscal deficits, not just in the US, but around the world. And it's really only been North American retail, if you like, or North American generalist investors, not necessarily retail, but North American generalist investors have only just begun to dip their toes into the water. But I mean, that's obviously, we know that's what's been driving gold. What's a bit surprising to me, to be honest, is, we had the spike in October where everybody was saying, we were saying gold's just moving too far, too fast. And we had the pullback. But the pullback has been extremely shallow, and there was no follow through at all after it got to, as you say, it dipped under 4,000. But there was no follow through. And I think that what that tells us is that there's just an awful lot of pent up demand on the sidelines from people who missed it on the way up. And, this is human nature, but it happens with every market. At 3,000, you say, well, I'm not buying gold at 3,000. I'll wait for a pullback. And it goes to 32. Well, 32, my gosh, I'll wait for it to get to 3,000. And then suddenly you're at 44,000, having just dipped from 44, and you jump in, right? Because it's pulled back. But I think there's just a lot of demand on the sidelines. And of course, the central banks are continuing to buy. It's less than it was a year ago, but it's still, in the context of the last 5 years, it's still very strong demand. And importantly, it's diversified demand. It's not just one central bank. It's not just China, as you know, but it's very diversified central bank demand. And that's continuing. In ebbs and flows, but it's continuing. So yeah, I mean, I feel the big issue, the big question for me, Kai, is not so much how low gold is going to go. I think, and I hate to jinx it, but I think we've probably seen the low of the correction. I thought it would go lower, but at this point, I would say we've probably seen the low. The big question is just how far, how long does it take?
Yeah.
And I'm sorry if I may say just one thing before and I'm sorry to go on for so long. Yeah, because these pullbacks often last a lot longer than people think they will. But to me, the big concern in the next couple of weeks, frankly, will be the Federal Reserve. And you mentioned 85% basically probability. That's what the markets are saying, 85% probability of a rate cut. And gold has priced that, right? Gold has priced that in. 2 weeks ago, it was more like 50-50. In fact, it was even a little less than 50% for a rate cut. But at this point, with an 85% probability of a rate cut, and with gold having already discounted that, the risk, of course, is that the Fed either doesn't cut or cuts with an extremely hawkish message. And that could see gold come down. So, as you know, in this business, we're not really in the business of making predictions as to what's going to happen. It's looking at what we think is going to happen in the context of risk and reward and in the context of what's already discounted in the market.
The US dollar finally did what it was supposed to do. It fell against major global currencies amid signs of weakness in the US economy and renewed chances of an interest rate cut by the Federal. In recent days, the baseline scenario has been a cut in December and a further pause. However, the Fed's decisions depend on data, and the statistics are not encouraging. Not yet, but the foundations are shifting in ways that could reshape global finance within the next decade. The US dollar's share of global currency reserves fell to 57.7% in the first quarter of 2025, down from 57.8% at the end of 2024, marking a continued erosion of its once unassailable dominance. Adrian Day sees the dollar's recent rebound as mild and temporary, and he expects a weaker dollar over the next 12 to 18 months. Now let's jump straight into the content.
I think gold has to a large extent diverged from the dollar because, again, it's been central banks that have been buying, and they are not overly concerned with the level of the dollar. Now, if the dollar were to collapse, it would add to the urgency of central banks to diversify out of the dollar. But I don't think it's dependent upon a weaker dollar. U.S. generalist investment is to a large extent dependent on the dollar because U.S. investors, or North Americans generally, but North Americans don't buy gold in general terms, don't buy gold for the same reason that people in Asia or people in the Middle East or people in Europe buy. We don't have, in North America, they don't have that sort of history of where gold actually saved you. The Chinese in Hong Kong have that history where gold, when they brought gold over after Mao took over, it saved them. Vietnamese have a history of gold. Germany, Italy, these countries, it's still in the DNA that gold is a safe haven asset. We don't really have that in North America. So in North America, people tend to buy much more on simply the economic environment. So that's a weakening economy, lower interest rates, high and rising inflation, and a lower dollar. And, the truth is that up until very recently, I think one could argue that all of those four factors were exactly the opposite of what they need to be to get people interested in gold. Now, with regard to the dollar, so I think the dollar is important for U.S. investors. I don't think it's very important for the main people who have been buying. And that includes Tether, the Chinese, the central banks. I don't think the dollar is that critical for them. We know that the dollar had the largest first half decline since 1974. That's pretty astonishing. And so after you get something like that, and of course the first half of the year is an arbitrary measurement, but nonetheless, it was the sharpest decline, first half decline since 1974. After something like that, you would expect a recovery rally. And I would argue that the recovery rally we've seen, from 97 or something, 96 and a half to 99 and a half, the recovery rally that we've seen is very, very mediocre. And so I wouldn't be at all surprised if the dollar maybe goes up a little bit more, 100, 102 on the Dixie. But a year from now, it's likely to be lower. And that's particularly since if the Federal Reserve is cutting rates, meaning the arbitrage between US rates and foreign rates, closes even more. And you've got an administration that doesn't seem particularly interested in having a strong dollar. So I think the odds are that the dollar weakens over the next, year, 18 months, albeit after a bit more of a recovery in the near term. But this recovery is very, very mediocre.
The huge momentum behind gold is not accidental. It is being influenced by major forces of the world, and it is only beginning to take shape. The buying by central banks is at record levels. The purchasing by the rich of Asia and the Middle East is rising at records, and the global demand has been at its peak quarterly ever. The purchasing has not abated even with all-time high prices, which indicates how firmly the world is transitioning towards gold as a reliable protection against increasing debt, political instability, and financial risks. As the rate cuts are predicted in 2025, the softer dollar is likely to come soon, and the uncertainty in the world is growing. It is believed that the story of gold is not yet finished. Provided that these trends persist, there is even more demand that may come in the next year and, in fact, new record highs. Do you think gold is becoming the world's preferred safe haven again, or is it just temporary? We'd love to hear your thoughts in the comments below. If you enjoyed this video, give it a thumbs up and make sure to subscribe for more updates. Thanks for watching.